Welcome to the deep dive, where we really try to peel back the layers on businesses you might interact with every day, but maybe don't think twice about. We aim to uncover the really extraordinary stories hiding beneath the surface. Today, we're zeroing in on a financial powerhouse, one that operates quietly behind the scenes of literally millions of transactions every single day, often starting with something as simple as unassuming as a meal voucher. So let's talk about Edenred. Now, you might not recognize the name instantly, okay? But their services are so deeply woven into daily life for people all over the world, it's almost guaranteed you've interacted with them somehow. What's genuinely captivating about Edenred and why we're digging in today is this profound paradox. You've got a business model that is fundamentally stable, it's demonstrably growing, incredibly cash generative.
Rock solid, fundamentally.
Exactly. Yet its market valuation, its stock price, has been, consistently punished, hammered even, by skepticism, by a relentless series of regulatory challenges, headwinds you might call them.
Big headwinds.
It's a compelling puzzle, right? Which makes it absolutely perfect for one of our deep dives. So, our mission today is to thoroughly dissect Edenred's unique business model. We want to unravel its powerful growth engines, which stretch, far beyond its origins in meal vouchers. We also have to confront the very real regulatory risks, the stuff that has sent jitters through the market, spooked investors.
Definitely need to talk about that.
And ultimately, we want to figure out what all of this means for you, our curious listener, whether you're maybe an investor eyeing hidden value, or perhaps a business professional grappling with employee benefits, or maybe you're just someone fascinated by the unseen forces shaping our digital economy.
Yeah, and the compelling aspect here is precisely that dichotomy you mentioned, that hidden tension. Edenred thrives in what we call the earmarked payments niche.
Earmarked payments, okay.
Now, that might sound a little, shall we say, unglamorous, a bit dry maybe.
Not exactly fintech hype, yeah.
No, exactly. Yeah. But this isn't about flashy apps. It's about a deeply ingrained, highly sticky service. And that allowed them to build this massive global platform. You've hit on it. This isn't just about meal vouchers anymore, not by a long shot. It's a sophisticated, interconnected ecosystem.
Right.
And you're right, the market has indeed been remarkably harsh. Not only on Edenred, but also on its closest competitor, Pluxee, over the past year or so. We're not talking about a minor correction here. Their market caps have seen some serious declines.
Really significant drops.
Which tells us there's a powerful narrative unfolding, doesn't it? One that needs careful examination to understand why these incredibly profitable, well-established businesses are currently being viewed with such skepticism. But, and this is key, underneath that surface layer of market apprehension lies an exceptionally robust operational model. There's a certain hidden leverage and a profound competitive advantage that this business inherently possesses.
Hidden leverage, I like that.
It allows it to generate those impressive margins, those really strong cash flows, despite the very real external pressures we're going to talk about. So we'll delve into how these foundational strengths are contending with these sudden and sometimes, let's be honest, politically charged shifts in the regulatory landscape, and maybe question whether the market is truly seeing the full picture here.
Exactly. So let's literally begin at the beginning. What exactly is Edenred at its very core? How did it evolve into such an influential player in this rather specialized financial space? Their story is actually quite rich, isn't it? It stretches back over 6 decades.
A long time.
Yeah, it all kicked off in France back in 1962. They introduced what we now know as meal vouchers, famously branded as ticket restaurant.
The original.
The original. It was a pretty revolutionary concept for employee benefits at the time. And the idea was so successful that by 1967, it earned official recognition as an employee benefit in France. That really cemented its place in the economic fabric there.
Became part of the landscape?
Absolutely. And its appeal wasn't just confined to France. Other countries started adopting the system pretty quickly, expanding Edenred's global reach from 1976 onwards. Then, in the early 2000s, they made a strategic pivot. They broadened their portfolio into fleet and mobility solutions, fuel cards, that sort of thing. They recognized the synergy there with their core B2B payment expertise.
Makes sense. Same kind of platform thinking.
Right. And a truly pivotal moment arrived in 2010. The company demerged from Accor, the hotel group, and became Eden as a fully standalone public entity. Now, this long history as a public company is actually a key differentiator, I think. It gives them deeper institutional knowledge, maybe more market experience, compared to, say, Pluxee, which is a much more recent spinoff from Sodexo.
Yeah, Plexie's only been public for about a year, hasn't it?
Just over, yeah. So post-merger, Edenred aggressively focused on digitizing its entire business, really pushed into new segments. They consciously positioned themselves as a leading digital platform for services and specific purpose payments.
Moving beyond the paper voucher.
Massively. This wasn't just an evolution, it felt like a deliberate transformation, a shift in identity, almost. Now, you hear us use this term earmarked payments quite a bit. Let's just make sure we're all on the same page there. What does that actually mean?
Basically, the fundamental service Edenred provides is offering prepaid solutions to corporations, to businesses.
Okay.
These corporations then use these solutions to provide various benefits to their employees. And the employees, in turn, access and use these benefits through digital cards, mobile apps, that sort of thing.
Got it.
The earmarking part is crucial. These funds are specifically designated, ring-fenced, you might say, for certain uses. Could be food, could be fuel, specific wellness programs, childcare.
So not just cash they can spend anywhere.
Exactly. It's not general spending money. It's purpose-driven. The money has a label on it, essentially.
Okay, so that seems fairly straightforward, right? Managing prepaid benefits. But what's truly genius, and perhaps a bit hidden from plain sight, is how they managed to turn that seemingly simple concept into such a significant revenue engine. It's not just one income stream, is it?
No, not at all. It's a remarkably clever tri-party revenue model. 3 main ways they make money.
Let's break it down.
Okay, first up, merchant fees. These are commissions Edenred charges to the vast network of restaurants, supermarkets, gas stations, all the merchants who accept their vouchers or cards.
Right, the places where employees spend the money.
Exactly. And what's particularly interesting here is that these merchants, even though they pay a fee, often feel kind of obliged to participate
Why's that?
because they rely heavily on the steady stream of customers brought in by these vouchers. Especially, for lunch business in cities or specific types of stores, it creates a powerful incentive to be part of the Edenred network. You don't want to miss out on those customers.
Okay, makes sense. That's stream number 1. What's next?
Secondly, Edenred collects customer fees. These are the charges paid by the corporations, and importantly, the small and medium-sized enterprises, the SMEs, that use Edenred services to provide these benefits to their workforce.
So the employers pay, too?
Yes. Businesses pay Eden for the whole package, setting up the system, managing the accounts, the cards, the app, the compliance, all of it. It simplifies things hugely for HR departments.
Okay, merchant fees, customer fees. What's the third piece? You hinted it was special.
Yes. And here's where it gets really interesting and frankly quite brilliant from a business model perspective. It's the interest on the float, or more technically, it's their negative working capital dynamic.
Okay, unpack the float for us. What does that actually mean?
Imagine this. Corporations deposit cash with Edenred, usually at the end of each month, right, to fund their employees' benefits for the upcoming month.
Right, they prepay.
They prepay. But here's the kicker. Employees don't spend that money instantly. On average, it takes about 7 weeks, almost 2 months, for an employee to fully use up those deposited funds.
7 weeks. Wow.
Yeah. So during that entire 7-week period, Edenred, as the platform owner, is holding on to that unspent cash. It's sitting in their accounts. And on that cash, that massive tool of temporarily unused funds, the float they generate, interest income.
So they earn interest on money that's technically owed to employees or merchants, but hasn't been spent yet.
Precisely. This float isn't just some minor accounting detail. It's a self-financing engine. Think about it. You're running a multi-billion-euro business where your customers essentially lend you huge amounts of money, interest-free, for weeks on end.
That's incredibly clever.
It's Edenred's secret sauce. It allows them to fund growth, acquisitions, shareholder returns without constantly needing to tap external capital markets. It's a truly unique structural advantage in their model. And if we connect this to the bigger picture, this float mechanism is truly the silent engine driving what we call an operating leverage model with a strongly negative working capital dynamic that generates interest income.
Okay, bit of jargon there, but the core idea is the float fuels the business.
Absolutely. It's a monumental competitive advantage. It allows Edenred to grow with exceptional capital efficiency. And it translates directly into those incredibly high EBITDA margins we see for Edenred, consistently hovering around 40%. That's huge for this kind of business.
40% margin, wow.
And robust free cash flow conversion rates. typically between 70% and 80%. So a huge chunk of their earnings turns into actual cash they can use.
So it's not just about collecting commissions.
Not at all. It's about the ingenious management and strategic use of that cash within their self-contained ecosystem. It's essentially like a perpetual motion machine for capital. It fuels further investment into their platform, it helps fund dividends and buybacks, consistently delivering strong shareholder returns. It's fascinating how something so seemingly technical becomes such a powerful strategic lever, isn't it?
It really is. That float, combined with the other revenue streams, the merchant fees, the corporate fees, it creates this powerful, almost self-reinforcing flywheel, doesn't it?
Exactly. And this is where the power of network effects really kicks in.
Right, the ecosystem idea.
Yeah, it's a truly digital ecosystem where every party involved gets something out of it, which in turn strengthens the whole system.
Okay, let's walk through that. Who benefits?
Well, employees are perhaps the most direct beneficiaries. They receive tax-advantaged benefits. In many countries, France, Brazil, Italy are big examples. They don't pay payroll or income taxes on the value of these vouchers.
So it's worth more than just getting the same amount in cash salary.
Correct. It significantly boosts their purchasing power, that's real money in their pockets, especially for lower and middle-income workers.
Okay, good for employees. What about the companies, the employers?
For corporations, it's a win-win. They can attract and retain top talent without having to drastically increase base salaries, which have all sorts of knock-on costs. Plus, Edenred's system vastly simplifies their benefits administration. Imagine trying to manage individual meal reimbursements for thousands of employees. Nightmare. This streamlines it, reduces HR headaches.
Makes sense. And the merchants, we touched on them getting customers.
Exactly. For merchants, they are guaranteed a steady flow of clients. Think about a small restaurant near office buildings or a supermarket. Those guaranteed voucher users mean increased sales volume, predictable foot traffic. They might grumble about the commission fee.
Which we'll get to.
Oh, yes. But they know they need to be in the network to capture that business. So it's this beautifully constructed three-sided market that reinforces itself. More users attract more merchants, which makes the platform more appealing to corporations, which brings in more users, and round it goes.
A virtuous cycle.
Pretty much.
And this isn't some small niche local operation we're talking about. Edenred's scale and global footprint are genuinely immense.
Oh, absolutely huge.
We're talking about a digital network that seamlessly connects. Get this. 60 million users.
60 million.
2 million partner merchants and 1 million corporate clients across a staggering 45 countries.
It's a vast web.
And to put that in perspective, in 2024 alone, they managed close to $45 billion in business volume. That's the total value of transactions flowing through their platform.
45 billion euros. Just processing these specific payments.
Yeah, and critically, this isn't just about dominating established markets like France. They are actively operating and expanding in what they call under-penetrated markets, which basically means there's still enormous untapped potential for growth. They can extend these digital benefits to even more businesses and employees worldwide, especially in regions where these kinds of formal benefits are less common today.
Lots of runway left.
Definitely seems like it. Okay, so while those iconic meal vouchers, the ticket restaurant, might be their most recognizable product globally, Edenred has been incredibly strategic in moving beyond food.
Diversification has been key.
Absolutely. And this was where it gets really interesting, I think. They've consciously evolved from, basically a single product company into this sophisticated, multi-vertical digital platform. The first, and still the largest segment, is benefits and engagement. This is the mothership, really. It accounted for a significant 65% of their operating revenue in the first half of 2025, bringing in a substantial $867 million just in those 6 months. Still the core.
Still the core. Within this, their core meal and food solutions naturally remain primary. That generated a robust $1,121 million in the full year 2024, which is still, 43% of their total operating revenue. So food is still vital.
Can't forget the roots.
Never. But the real narrative of diversification here lies in what they call beyond food solutions. This is a much broader and rapidly expanding array of offerings. Think comprehensive employee engagement platforms, versatile gift cards, for holidays or bonuses, platforms dedicated to employee well-being, support for childcare, gym memberships, even transportation solutions like commuter benefits.
A whole suite of HR-related tools.
Exactly. And a critical part of their strategy to fuel this growth is through targeted acquisitions, smart buys. For example, in 2023, they acquired Reward Gateway and GoIntegro. Both are significant players in the employee engagement platform space.
Right, I remember those deals. These platforms, they essentially function as like internal corporate social networks. They facilitate things like peer-to-peer recognition, employees giving kudos to colleagues, and they give employees seamless access to a wide spectrum of benefits all in one place.
So integrating everything.
That's the idea. And the elegance here is the inherent cross-selling synergy. Eden can leverage its already established sales force, its deep relationships with HR departments built over decades with meal vouchers.
Use those existing connections.
Precisely. To effortlessly cross-sell these new platforms, they integrate their traditional benefits like food vouchers directly into these comprehensive new digital offerings.
Makes a lot of sense. Sell more to the clients you already have.
And we're seeing this strategy really accelerate growth, particularly in Germany, actually. That was a market that was previously pretty underpenetrated for their benefits and engagement solutions. Through a complete overhaul and revamp of their digital offering there, Eden managed to cut customer onboarding time fourfold, which is huge for sales efficiency, and effectively double the monetization for its 2 million users in that key market.
Wow, doubling monetization. That's impressive.
Yeah, it's a powerful testament to their platform approach working on the ground. Okay, moving on from benefits, we have mobility solutions. This segment contributed 26% of their operating revenue in the first half of 2025, totaling $347 million.
So about a quarter of the business.
Roughly. This segment includes their long-standing traditional fuel card business. Think cards for truck drivers, sales fleets, etc. And that continues to show strong momentum, particularly across Europe, with solid growth in the sheer volume of fuel the leaders sold.
Still a big market, traditional fuel.
Oh, definitely. However, the strategic emphasis, again, just like with food, is on the beyond fuel strategy.
Expanding the offering.
Exactly. They are proactively expanding well beyond just selling fuel. They're integrating solutions for vehicle maintenance, electronic tolls, which is a huge headache for fleets, comprehensive freight management software, and even parking solutions.
All the related costs for running vehicles.
Right. And these beyond fuel solutions are experiencing rapid growth. They accounted for 32% of mobility operating revenue in H1 2025. That's up noticeably from 30% just a year earlier in H1 2024.
So that piece is growing faster than the core fuel part.
Seems so. And a particularly significant area of investment here, as you'd expect, is electric vehicle EV charging.
Got to be in EVs now.
Absolutely. Eden has poured substantial resources into this, including the strategic acquisition of Spiry. That's an innovative platform that aggregates EV charging stations across Europe, makes it easier for fleets to find and pay for charging.
Smart acquisition. Fragmented market.
Very. And they are also aggressively adding EV charging points to their existing UTA network. UTA is a major player in European Fleet Solutions' huge network. This combined effort gives them access to an impressive 925,000 charging points across 28 countries.
Yeah.
That firmly positions them for the inevitable shift in fleet mobility towards electric.
Yeah, 925,000 points is serious scale. And what's truly remarkable here, I think, is how Eden deftly adapts to the incredibly diverse market needs within the mobility sector. It's not one size fits all.
How so?
Well, for instance, in European markets, the primary drivers for fleet clients, the main selling points, are often focused on fuel cost optimization, getting the best price per liter, seamless expense management, and just having really extensive network coverage, making sure drivers can fill up or charge up anywhere.
Right, efficiency and reach.
But in a market like Brazil, it's different. While cost efficiency is always important, of course, the most critical selling points for their fuel card solutions there, like their ticket log brand, often revolve around robust control features, advanced fraud prevention, which is a bigger issue in some markets, and really granular reporting capabilities.
So different priorities depending on the country.
Exactly. It highlights their deeply localized and agile approach. They're not just pushing a single global product. And the strategic insight here, the real stickiness factor, is the deep integration of their solutions with client ERP systems, enterprise resource planning, and their TMS, transport management systems.
Plugging right into the client's core software.
Precisely. Once Eden is deeply embedded in a company's operational data flow, their financial processes, managing fuel expenses, tolls, maintenance, moving to a competitor becomes an exceptionally complex, costly, and disruptive undertaking. You'd have to rip it all out and start again.
Creates huge switching costs.
Massive switching costs. That stickiness is a fundamental competitive moat in the mobility segment.
Okay, makes sense. Finally, there's the third segment. Complementary solutions. This represents about 9% of their H1 2025 operating revenue, bringing in $125 million.
The smallest piece.
The smallest and maybe the most diverse. This segment is a bit of a mix, including offerings like corporate payment services, often using virtual cards for specific B2B payments, various incentive and rewards programs for employee motivation or sales team bonuses, and also the administration of public social programs on behalf of government.
So using their payment platform for other things.
Pretty much. The performance within this segment has been somewhat mixed recently. They've certainly seen strong growth from Edenred's C3 Pay in the UAE. That's been a highlight. However, it's also been affected by a planned exit from a B2C business they had with some fintechs. It was a kind of banking as a service offering that, well, it just no longer aligned with their core B2B strategy.
Right, refocus.
Yeah. There's also lower performance reported from Edenred Pay North America, which used to be called CSI, plus the non-renewal of a specific public social program contract in Romania and a strategic rebalancing of another government program they ran in Chile. So it's a dynamic, actively managed portfolio within this smaller segment. They're clearly tweaking it.
And if we connect all this back to the bigger picture, this extensive diversification across benefits, mobility, and these complementary solutions, it isn't merely about adding new revenue streams just for the sake of it.
It's strategic.
It's absolutely central to Edenred's overarching Beyond 22-25 strategy. It strategically leverages their core digital platform, that asset they've invested so heavily in, to aggressively seize opportunities in high-growth markets, whether that's the expansion of employee benefits into a largely underpenetrated market like Germany, like you mentioned, or their significant investments in the rapidly expanding EV charging sector within mobility. This diversification is a critical component of their resilience. It fundamentally insulates them, to some extent, against sector-specific risks, like, for example, the regulatory changes we're about to dive into in their core meal voucher business.
Ah, okay. Spreading the risk.
Exactly. It effectively spreads their bets, making them far less reliant on any single product, service, or geographic market, which is crucial, frankly, in today's unpredictable economic and political climate. It makes the whole ship more stable.
Okay, that makes a lot of sense. So now that we've firmly grasped what Edenred does and how it structures its incredibly diverse range of services, let's turn our attention to how well it's actually doing financially.
The numbers bit.
The numbers bit. The latest results from the first half of 2025, they paint a picture of continued strength in many key areas. But as always, there are certain points that, savvy investors are monitoring very closely. Overall, Eden reported a truly robust half-year 2025 performance. Let's hit some key figures. Their total revenue clocked in at $1,451 million, or about 1.45 billion euros.
Just for the half year.
Just for H1. That's an impressive 6.4% increase on a like-for-like basis, meaning adjusting for acquisitions and currency swings compared to the first half of 2024. Now, the reported growth, the number you see in the headlines, was slightly lower at 4.0%. That difference is primarily due to some unfavorable currency effects, particularly strong euro maybe, though these were partially offset by a positive scope effect from recent strategic acquisitions they made.
So underlying growth is strong.
Underlying growth looks very solid, yeah. Digging deeper, operating revenue, which excludes that interest income from the float for a moment, was $1,339 million. That climbed a solid 7.1% like-for-like, or 5.3% reported. And importantly, we saw robust double-digit like-for-like growth in both mobility and across Latin America, and maybe critically, an acceleration in benefits and engagement and across their European operations in the second quarter. That suggests strengthening momentum as the year progressed.
Good to see that acceleration.
Definitely. Now, their other revenue, which, as we discussed, primarily stems from the interest on that highly advantageous float that came in at $112 million for the half. It was down slightly, 0.6% like-for-like.
Okay, why was that down?
It reflects a kind of nuanced interplay. You had higher interest rates in Brazil, which helps the float income there, but that was somewhat tempered by lower interest rates in the Eurozone compared to the previous year.
A mixed bag on rates.
Exactly. However, Edenred has confidently confirmed a floor, a minimum expectation of $210 million for this crucial other revenue for the full year 2025, so they expect a stronger second half there. Now, critically, profitability. Their EBITDA earnings before interest, taxes, depreciation, and amortization, a key profit measure, reached a substantial $654 million for the half year. That demonstrates very strong 14.4% like-for-like growth. Reported growth was 9.6%.
Double-digit underlying profit growth. Impressive.
Very. And their operating EBITDA, which strips out that float interest to look purely at the operational performance, was up an even more impressive 18.4% like for like.
Wow, so the core operations are really driving profits.
It looks that way. And this translated directly into a remarkable EBITDA margin of 45.1%, almost half of their revenue turning into EBITDA. That's up a healthy 3.2 percentage points like for like, and the operating EBITDA margin was 40.5%, up 3.9 points like for like.
Those margins are seriously high.
They really are. And these significant margin improvements are a clear demonstration of the true power of operating leverage and efficiency that's inherent in their digital platform model.
Explain that operating leverage bit again.
Basically, as their revenue expands, their earnings grow even faster. Why? Because their underlying operating expenses, the costs of running the platform, staff, IT, are incredibly well contained. They don't grow as fast as revenue.
So more revenue drops straight to the bottom line.
Pretty much. This is partly thanks to their disciplined, fit-for-growth operating efficiency plan, which isn't just corporate jargon. It means they're constantly streamlining internal processes, leveraging automation, centralizing functions, essentially getting more bang for their buck as they scale. And that translates directly into those impressive margin improvements. And just quickly, for listeners focused on the absolute bottom line, their adjusted earnings per share, EPS, were also up a solid 7.4% to 1.16 for the half year, indicating consistent value creation for shareholders.
Okay, strong profit growth, margin expansion. What about cash? Is the cash flow matching the profit?
Great question. In terms of cash generation, Edenred remains a veritable powerhouse. Funds from operations before other income and expenses, or FFO, think of it as a measure of cash from core operations, hit $468 million in H1, sharply up by 17.0%.
Strong FFO growth.
Very. And their crucial annual target is to maintain a truly impressive free cash flow to EBITDA conversion rate above 70%. So turning over 70% of that EBITDA into actual free cash.
That's a high conversion rate.
Extremely high. Now, a quick important note on free cash flow, FCF,
Yeah.
specifically for H1 2025. It was actually negative.
Yeah.
Negative 118 million.
Negative. That sounds bad after all the positive numbers.
It does, but it needs context.
Oh.
This isn't necessarily a red flag for a company like Edenred, especially in the first half. It's primarily attributable to a few things. One, the seasonal nature of their gift card business. Lots of sales maybe before holidays, but cash comes in later. Two, some delayed payments they experience from public sector clients in Latin America. And three, the impact of recent acquisitions that required upfront cash investment.
Ah, so timing issues and investments.
Exactly. This is a fairly typical pattern for their first half of the year. The cash flow usually reverses strongly in the second half as working capital unwinds positively, so management wasn't concerned.
Okay, turning to their financial position and capital allocation. How are they using all this cash and managing debt? Edenred's net debt stood at 2,351 million, about 2.35 billion euros at the end of June 2025.
Okay, that's a fair amount of debt. It is, and it's up from 1,880 million a year earlier in H1 2024. The increase is primarily due to those recent strategic acquisitions we mentioned, like RB in Brazil, the IP energy cards business in Italy, and also significant shareholder returns, which we'll get to.
So investing in growth and returning cash.
That's the story. But despite this increase in debt, S&P Global Ratings reiterated their robust A investment grade rating in April 2025. Now, for our investor listeners, that A rating isn't just a letter grade. It's a crucial signal of financial robustness. Especially for a company using leverage like Edenred, it indicates significant confidence from the rating agency in their ability to service that debt comfortably and generate reliable future cash flow.
So S&P isn't worried about the debt level.
Apparently not. And critically, from a liquidity perspective, there are no major loan repayments due by the end of 2025, which provides ample financial flexibility in the near term. And speaking of shareholder returns, they returned a substantial $568 million to shareholders just in the first half of 2025. That was through dividend payments and an ongoing aggressive share buyback program.
Nearly 600 million back to shareholders in 6 months.
Yeah. And this buyback program is quite significant. It's a $600 million program authorized to extend until November 2027. As of June 2025, they'd already purchased $350 million worth of shares under this plan.
So they're actively buying back stock.
Very actively. And at recent prices, this represents, as they highlighted, more than 10% of the market capitalization being returned via buybacks alone, in addition to their generous dividend payment.
It's a huge return yield.
It really is. They even went a step further, canceling 1.6 million treasury shares they bought back in May 2025. That represented about 0.68% of their share capital, effectively reducing the share count permanently and boosting earnings per share for the remaining shareholders. It shows real commitment to returning value.
Okay, you've laid out a very clear picture of their financial strength, their profitability, the cash generation, the shareholder returns. It all sounds pretty good operationally. But that begs a question, doesn't it? How do these robust results align with Edenred's ambitious future plans, especially when you layer on that backdrop of market skepticism and regulatory noise we keep mentioning?
Exactly.
What's the outlook?
Well, the management team has certainly articulated a very clear and frankly aggressive path forward. They seem quite confident, despite the external pressures. Firstly, they've confidently confirmed all their 2025 objectives. That's at least 10% like-for-like EBITDA growth for the full year, which implies a minimum EBITDA of around $1,340 million, and maintaining that crucial free cash flow to EBITDA conversion rate above 70%.
And crudely.
And crucially, as you pointed out, these targets already include an expected $60 million negative impact from that Italian merchant fee cap we'll discuss more later. So they believe they can absorb that hit and still deliver strong growth. That's a statement of confidence.
It is. What about longer term? Looking further out, they have an incredibly ambitious long-term 2030 revenue target of $5 billion.
5 billion euros.
Yes, up from $2.9 billion in 2024. That's a significant leap, signaling their intent for continued aggressive strategic growth over the rest of the decade. They're not planning on slowing down.
Where is all that growth going to come from?
Good question. CEO Bertrand Dumazy has clearly articulated three core pillars underpinning this impressive growth trajectory. He estimates that a full 60% of this growth will come from simply continuing to expand in their underpenetrated core markets.
Just getting more customers for existing products in existing markets?
Pretty much. Think about it. France's meal voucher penetration is still only around 28% of the eligible workforce. Italy has just 3 million users out of a 23 million total workforce. Brazil, even though it's mature, is only at 25% penetration. There's still huge room to grow just by signing up more companies and users in these key geographies. And often, governments in these countries want increased usage. They see these benefits as tools to boost purchasing power for workers and support local economies, particularly small businesses like restaurants. So there can be a supportive policy environment sometimes.
Okay, 60% from core market penetration. Where's the rest?
Another 30% of the projected growth is expected to come from the acceleration of their beyond food, fuel, and payment solutions. That extensive diversification into employee engagement, mobility services beyond fuel, corporate payments, etc. that we just discussed. That part of the business is growing faster and becoming a bigger piece of the pie.
Makes sense. That leaves 10%.
And finally, 10% is expected from strategic expansion into entirely new business opportunities. Perhaps adjacent markets, new types of services, leveraging their platform. They're keeping some options open there.
Okay. Ambitious targets, clear pillars. What's enabling this?
And here's a key insight for you, something the market maybe doesn't fully appreciate amidst the regulatory noise. Technology serves as a profound competitive advantage underpinning this entire ambitious strategy.
How so?
Edenred has invested heavily, committing significant capital over several years now to developing a single, fully cloud-based, API-driven digital platform. This isn't just about internal efficiency, though that's part of it. It's a strategic move that paves the way for truly seamless global growth and the rapid deployment of new services.
One platform to rule them all.
Sort of, yeah. The costs associated with double running, maintaining both old legacy systems and this new platform during the transition are expected to decrease significantly as the migration is completed. This should boost margins further. And they proudly, and probably accurately, state they are the only player in the industry to own a specific purpose payment platform of this scale and modernity. This provides a powerful economy of scale. They can mutualize development costs, share technology across diverse payment programs globally, and accelerate development timelines.
Can you give an example?
Yeah, a perfect example they cited was launching something as complex as the Tarjeta Rosa program, a specific social benefit program in Mexico, in less than 3 weeks. That kind of speed and agility is only possible because they have this underlying modern, flexible tech stack.
Wow, 3 weeks is fast for that kind of thing.
Very fast. Furthermore, their core application for users, Edenred plus Ucro, is being continuously modernized. The goal is to facilitate effortless cross-selling of various benefits, food, fuel, wellness, gifts, all from a single intuitive app. And it's designed to seamlessly integrate those recent acquisitions like Reward Gateway and GoIntegro.
So better user experience, easier cross-selling.
Exactly. This technological edge is a fundamental strength in a rapidly evolving digital landscape. It allows them to innovate faster, launch products more cost-effectively, and integrate acquisitions more smoothly than many competitors who might be stuck on older, fragmented systems. It's a real tangible advantage.
Okay, that's a very compelling picture of operational strength and future potential. But, and it's a big but, despite all these impressive financials, these robust growth strategies, and that incredibly strong technological backbone we just discussed, Edenred stock has faced, well, immense pressure.
The elephant in the room. Regulation.
Exactly. Often it's due to factors that are largely, if not entirely, outside its direct operational control regulation. Let's truly unpack these regulatory headwinds that have created so much market uncertainty and, frankly, caused investors to seriously second-guess this otherwise formidable business.
Yeah, and what's truly fascinating here, and perhaps the core of the paradox we started with, is the inherent vulnerability that comes with such a significant portion of Edenred's business being tied to regulation.
How much are we talking?
A substantial 43% of their operating revenue comes directly from the regulated meal and food voucher market. That's the historical core.
Almost half the business directly exposed.
Precisely. This makes them intrinsically susceptible to government intervention, to policy shifts, to rule changes. And it's not theoretical. We've seen this play out vividly with regulatory caps in Italy, ongoing legislative discussions and proposed reforms in France, and those persistent market-moving rumors emanating from Brazil.
What's driving this regulatory attention?
Well, the underlying tension, often, is a long-standing dissatisfaction from merchants, the restaurants, the supermarkets, regarding the historically high commission rates charged by the voucher providers like Edenred and Pluxee.
They feel they're paying too much.
Right. Even though, as we discussed, these very merchants often feel obliged to participate because they rely on the steady flow of voucher users. It's this delicate balancing act. Merchants have limited power individually, so they often lobby governments to step in and regulate the fees, effectively tipping the scales.
Okay, let's get specific. Let's zoom in on case study 1, Italy's commission cap. What happened there?
So the historical issue in Italy was that commission rates for private sector meal vouchers were quite elevated compared to other countries. They could range anywhere from 5% up to, in some cases, reportedly 20%.
20%? Wow, that's high.
Very high. So in response to merchant pressure and political debate, a new law was introduced. It mandates a cap on these commission rates at 5% for all sectors, private and public, effective from September 2025. It's worth noting the public sector in Italy had already seen a 5% cap imposed back in July 2022, so this extends it to the whole market.
Okay, a hard cap at 5%. What's the financial hit for Edenred?
Edenred has openly estimated and been quite transparent about this, that this change will have a maximum negative EBITDA impact of $60 million in the year 2025, with the full annualized impact potentially soaring to $120 million once it's fully in effect for a whole year.
120 million euros wiped off EBITDA annually. That's significant.
It is significant. Now, their stated mitigation strategy involves actively working to rebalance their pricing model. Essentially, they plan on reducing the discounts offered to employers, the corporate clients. Apparently, those discounts were higher in Italy compared to other European markets, so they have some room to claw back margin from the client side to offset some of the loss from the merchant side.
Trying to shift the burden.
Basically, yes. Trying to maintain their overall profitability per transaction by adjusting who pays what. But this raises an important question, doesn't it? Is that estimated 120 million annualized impact disproportionately high? I mean, when we consider Edenred's total meal voucher revenue in Italy was around 315 million in 2024.
Right.
120 million hit seems massive. If we look at other markets, say France, Edenred's average take rate, the commission they earn, is reportedly less than 4%. So even if Italy's commission rates are simply reduced to the mandated 5% cap, it seems plausible the average take rate would likely remain above France's level, which might suggest the actual EBITDA impact could potentially be less severe than that maximum 120 million estimate.
So maybe they're being conservative with the estimate.
Possibly. Or maybe the previous Italian margins were just that high. Interestingly, Pluxee, Edenred's closest competitor, has also reported making good progress in rebalancing its revenue model between merchants and corporate clients in Italy. That could certainly hint that the actual impact across the industry might not be quite as dire as the initial worst-case forecast suggested. It implies there's some room for strategic maneuvering, some ability to adapt the model.
Okay, Italy is one major headache. What about case study two? France's meal voucher reforms. France is their home market. Huge for them.
Indeed. France is critical. In June 2025, legislative proposals for changes were introduced there too, but crucially, and this was a significant relief for Edenred and the industry at the time, both the French government and, importantly, the French Competition Authority explicitly ruled out imposing a direct cap on commission rates like Italy did.
Ah, so no price cap in France.
Correct. That avoided a direct repeat of the Italian scenario, which was a big win. The specific proposed changes included things like mandating full digitalization of the sector by January 1st, 2027, getting rid of the last paper vouchers, allowing users to use vouchers on Sundays, which could, in theory, boost consumption slightly, prohibiting year-end discounts for corporate clients, which generally benefits incumbents like Edenred, by reducing the incentive for companies to shop around and switch providers based on discounts, and a return to a strict one-year validity period for vouchers, again, encouraging more rapid consumption.
So those changes sound okay, maybe even slightly positive.
Initially, the assessment of those proposals, before September 2025, was largely considered neutral or potentially slightly positive for Edenred. France also maintains relatively high barriers to entry, as merchants typically have to register individually with each voucher provider they want to accept. This naturally favors established players with large existing networks.
Okay, so France looked relatively stable, maybe even improving, until...
Yeah. There was a crucial and dramatic update on September 17, 2025. News broke, and it hit the markets hard, about a potential 8% French tax on meal vouchers and other specific employee benefits, like CESU vouchers, used for personal services, sports passes, cultural activities.
An 8% tax on the value of the voucher.
That was the proposal causing the stir. This immediately sent the stocks of both Edenred and Pluxee plunging again, reflecting acute market concern about their most important European market after Italy.
What would the impact of such a tax be?
The potential impact is indeed significant. Now, meal vouchers are widely seen as almost essential in France. They boost purchasing power, support local restaurants, they're deeply ingrained. So if an 8% tax were implemented on the face value of these benefits, the thinking is that employers would likely cut other, less essential benefits before they touch the meal vouchers.
So maybe meal vouchers survive, but other stuff gets cut.
Possibly. But even so, the tax could still significantly reduce Edenred's revenue potential in France. It might dampen demand from companies, especially SMEs, which was a core part of their French growth strategy. In a really negative case scenario analysis that circulated, France's contribution to Edenred's EBITDA could potentially fall by half, or approximately $75 million per year.
Wow, another big potential hit.
Yeah. This new tax proposal is a serious and immediate consideration. It definitely shifted the risk profile for the French market significantly almost overnight. It's no longer looking like a stable haven compared to Italy.
Okay, Italy capped, France potentially taxed. What about the third big market? Case study 3. Brazil's PAT reforms and market uncertainty.
Brazil. Brazil is incredibly important in this space. It's the #1 market for Pluxee and the second largest for Edenred globally. And it's arguably the most mature market in adopting these kinds of employee benefits, largely through the PAT system, the Workers' Food Program.
So what's the issue in Brazil?
Well, back in April 2025, a significant and pretty alarming rumor emerged. Reports surfaced that the Brazilian government was considering completely replacing the traditional meal voucher system, the PIT system, with direct payments into employees' bank accounts using Pix.
Pix? What's that?
Pix is Brazil's incredibly popular and highly efficient instant payment system. It allows direct bank-to-bank transfers instantly 24/7, and it's ubiquitous now. The stated aim behind this rumored shift was ostensibly to reduce food inflation by cutting out the intermediaries, like Edenred.
Replacing vouchers with direct cash deposits via Pix.
Exactly. Naturally, the market reacted badly because this would mean a large impairment to Pluxee and Edenred Brazil business. It would fundamentally alter the current system, removing that core earmarked functionality that defines the whole industry.
What are the concerns about just giving cash instead?
Well, plenty. Firstly, it would be incredibly hard, maybe impossible, to track if the funds are actually used for food, which is the whole point of the PAT program's tax benefits.
Yeah.
If you can't track it, you likely lose the crucial tax incentives for companies offering the benefit. And if the tax benefits disappear, there's a real risk that companies, especially during tough economic times, might just cut these non-mandatory payments en masse. which would ultimately hurt the lower-income consumers who rely heavily on these benefits for their daily food budget. It could backfire badly.
So the PIX idea seems problematic. Has anything actually changed in Brazil recently?
Brazil has already seen several waves of regulatory changes impacting the PAT system since 2022. There's been a prohibition of offering negative commissions or excessive rebates to corporate clients.
Negative commissions, paying companies to take your service.
Essentially, yes. Aggressive discounting to win contracts. Banning that, counterintuitively perhaps, is generally seen as good for incumbents like Edenred and Pluxee, as it reduces the incentive for companies to switch providers based purely on unsustainable pricing. Makes the market more stable.
Okay, what else?
There's also been a strong regulatory push for two main things: interoperability and portability. Interoperability means that any payment terminal that accepts one brand's meal voucher card must accept all other brands.
Like credit cards work?
Exactly. Reduces the need for merchants to have multiple machines. Portability means employees should have the right to transfer their accumulated benefit balances from one provider, say Edenred, to another, say Pluxee, if they choose.
Giving employees more choice.
That's the idea. However, the practical implementation of both interoperability and portability has been postponed multiple times. There are technical and commercial complexities. This creates ongoing uncertainty about when or even if these changes will fully come into effect.
And what about competition in Brazil?
Competition is definitely a factor there. You have newer entrants, fintech players like Swile and Flash, who often use open-loop payment systems. That means they leverage existing credit card networks like Visa or MasterCard for their benefit cards.
So they don't need to build their own merchant network.
Correct. This allows them to create vast merchant acceptance networks very easily, bypassing the need for Edenred's more proprietary, traditionally closed-loop network where they sign up merchants directly. It lowers the barrier to entry significantly.
How are Edenred and Pluxee responding to that?
Well, the incumbents like Edenred aren't standing still. They are quickly adopting hybrid approaches, just like they've done in France with the CONSSS network, which is a shared payment infrastructure enabling interoperability across different voucher providers. They're implementing similar strategies in Brazil. They're integrating with existing payment networks where it makes sense, effectively closing that competitive gap created by the open-loop challengers. Their scale helps them adapt.
Okay, so lots of moving parts in Brazil. What's the absolute worst-case scenario people are talking about there?
Looking at a worst-case scenario for Brazil, based on some analyst updates from around September 3rd, 2025, a truly dire, though perhaps unlikely outcome would be Edenred effectively exiting the meal and food voucher business entirely in Brazil due to regulatory changes making it unviable.
Just shutting down that part.
In this extreme scenario, yes. Analysts estimated this could result in a loss of around $233 million in annual revenue for Edenred and a maximum hit to EBITDA of $120 million.
Another 120 million hit, same as Italy's estimate.
Roughly, yes, in that worst-case analysis. However, it's critical to remember, even under such severe pressure, like if commission caps were imposed but the system wasn't scrapped entirely, Edenred could likely still generate significant revenue. One estimate suggested at least $140 million in EBITDA could still be possible, based on their 7 million Brazilian users multiplied by a conservative estimated revenue per user.
So even the worst case might not be zero.
Exactly. It demonstrates that even under extreme regulatory duress, the underlying business, the service itself, still has significant revenue-generating capacity. It's seen as essential by many employers and employees, which gives it resilience. So, stepping back and doing an overall regulatory risk evaluation, when you look at the aggregate picture across Italy, France, and Brazil, the consensus view among many analysts seems to be that the total actual negative EBITDA impact from the currently proposed or likely reforms in France and Brazil is expected to be significantly lower than the potential 120 million annualized impact estimated for Italy.
So Italy might be the worst of it.
Italy seems like the most concrete, severe impact already legislated, partly because, as we discussed, restaurant owners and other merchants typically possess the least negotiating power in this tri-party system. They often rely on government intervention to address commission rates. This dynamic limits the likelihood of extreme rate caps being imposed elsewhere, outside of a unique situation like Italy where rates were historically very high.
And what about companies switching providers? Is that a big risk?
Well, switching costs for employers are generally described as relatively low, yet sticky, meaning it's not technically impossible or prohibitively expensive for a company to switch providers.
But they tend not to.
Exactly. Corporates often see little additional value in switching providers for what they perceive as a standard service, especially now that aggressive discounting is being restricted in markets like Brazil. As long as incumbents like Edenred can match the core features and service levels offered by new entrants, which their scale and technology investments allow them to do, that historical high client retention rate, typically around 95%, is very likely to remain stable.
So the customer base is quite loyal, or at least quite sticky.
Very sticky.
Yeah.
The market might be overreacting somewhat to the headline risks without fully appreciating the underlying resilience and stickiness of the customer base and the essential nature of the service.
That's a crucial point. Okay, so beyond this incredibly intricate dance of regulation, which is clearly the main overhang, what are the broader economic factors that could still impact a company like Edenred?
Good question. You always have to consider the macro environment. Recession risk is the obvious one.
How would a recession hit them?
It's interesting. Their core meal voucher business is generally considered most resilient during downturns. Why? Because it's perceived by many employers as an essential employee benefit tied to daily needs. It's often one of the last things they'd cut, even if they are reducing their workforce overall.
So food vouchers hold up okay. What about other parts?
Their mobility business, the fuel cards and related services, would almost certainly contract in a significant recession. Fewer goods being shipped, sales teams traveling less, means fewer kilometers being driven by fleets, less fuel bought, fewer tolls paid. That part is more cyclical.
Okay. Any other broader risks?
Well, yeah, the more abstract, longer-term potential impact of job losses due to AI automation, which could shrink the overall pool of employees receiving benefits. And then there's just general investor sentiment shocks based on expectations. Markets can overshoot, both on the way up and on the way down.
Yeah, it definitely feels like sentiment has swung hard against them.
Absolutely. You could argue that a year or two ago, all the underlying good news we've discussed, the strong fundamentals, the diversification, the tech platform, was arguably fully priced into Edenred stock, maybe even overpriced. Now, with a stock trading at potentially a third of that peak price,
It gets interesting.
it gets profoundly interesting despite these very real risks, precisely because the market has arguably overreacted, lumped Eden in with general market fears, and perhaps excessively discounted the company for these external pressures. The pendulum might have swung too far.
Okay. So given these incredibly complex dynamics, you've got this fundamentally robust cash-generative business on one hand, and then these significant, often politically driven regulatory headwinds swirling around it on the other. Where does Edenred truly stand as an investment? As you said, the market seems to have truly thrown it out with the bathwater.
That's a good way to put it. The baby and the bathwater.
The current market sentiment and stock performance certainly reflect this deeply negative perception right now. The stock has crashed, as we said, from its previous highs. It's trading at multi-year lows, even, as you mentioned, at a third of that price compared to where it was maybe a year or two ago at its peak.
Striking decline for such a profitable company.
Absolutely. We saw those dramatic drops recently, a 17% plunge for Edenred, 10% for its peer Pluxee, just on the initial news of those Brazilian regulatory rumors back in April 2025. And then another significant plunge for both stocks followed the news of that potential French tax proposal on September 17th, 2025. It just shows how incredibly sensitive the market is right now to these external, often politically motivated factors, maybe more so than the underlying operational strength.
Headlines are driving the price action.
Seems that way. Let's look at some valuation metrics for context. Now, these figures are based on a stock price around 26, largely predating the very latest French tax news hitting the market, so keep that timing in mind.
Okay, what did the multiples look like then?
At that point, Eden was trading at a price-to-earnings TE ratio of about 12.5 times trailing earnings, with a forward PE based on analyst estimates of around 10.3 times.
So 10 times forward earnings. Pretty low for a growing tech-enabled platform.
Seems low, yeah. Its enterprise value to EBITDA multiple stood at about 7.95x and EVIBIT at 10.3x. The trailing EV to free cash flow, EVFCF ratio, has fluctuated a bit, given the seasonality we discussed, but generally somewhere between 10x and 13x.
Again, those seem like fairly undemanding multiples.
While they aren't necessarily historically rock-bottom multiples for all industries across the market, they represent a very significant discount compared to Edenred's own historical valuation range over the past decade. It strongly suggests the market is baking in a substantial amount of risk, maybe even a worst-case scenario, into the current price.
Pricing in a lot of negativity.
Exactly. And turning to shareholder returns, which we touched on, even with the stock price depressed, Edenred offers a truly compelling yield proposition right now.
Yeah, also.
Well, its dividend yield, based on the last declared dividend and recent prices, is quite attractive, hovering around 4.5% to 5%. That's a solid income stream to start with.
Decent dividend in today's market.
Definitely. But adding significantly to this is that new aggressive share buyback program we mentioned, 600 million authorized. At recent market capitalizations, that buyback alone represents more than 10% of the market capitalization.
So buying back over 10% of the company?
Potentially, yes, over the program's life. So when you combine that generous dividend yield of, say, 4.55% with the potential impact of a buyback reducing the share count by maybe 3-5% per year, you're looking at a formidable combined double-digit yield for shareholders, potentially an 11% yield or even more, just from dividends and buybacks.
That's a powerful return even before any growth.
Exactly. And if you then optimistically factor in their projected, say, 5% underlying organic growth on top of that, well, that's already a theoretical 15% total yield or return potential for shareholders. This signals a company that is robustly returning substantial value to its owners, even amidst this period of heightened uncertainty. That's a powerful message for long-term investors, isn't it?
It really is. That's a fantastic point on the shareholder return angle, particularly when you combine it with the current valuation levels. It suggests management sees value in their own stock. Maybe let's take a moment now to explicitly compare Eden to its closest listed competitor, Pluxee, just to help listeners understand the broader competitive landscape and perhaps Edenred's specific strategic advantages or disadvantages. These two companies are truly the two giants of this specific industry, yet they have quite distinct profiles, don't they?
They do. How would you characterize the key differences?
Well, Edenred, as we've established, is widely regarded as the benchmark and the established market leader. It boasts that incredible 60-plus years of history in this space. It emerged from Accor way back in 2010, giving it that longer, more established track record as a standalone public entity. Crucially, its product portfolio is significantly more diversified, which we've seen is a key factor in its resilience. Remember, roughly 63% in benefits and engagement, 25% in mobility, and 12% in those complementary solutions.
Much less reliant on just meal vouchers.
Exactly. And Edenred consistently achieves higher EBITDA margins, often exceeding 40%, which is a testament to its operational efficiency, scale, and that lucrative float mechanism we discussed. Now, as you mentioned, it carries significant debt largely from those strategic acquisitions and the shareholder returns,
But still A-rated.
but still maintains that strong A rating from S&P, indicating a remarkably robust financial position despite the leverage. So that's Edenred, the diversified, high-margin, leveraged leader.
Okay. And Pluxee.
Pluxee, on the other hand, is the newcomer as a public company, a recent spin from Sodexo, having become standalone just over a year ago. Consequently, it's much more concentrated in employee benefits. That segment accounts for 83% of its revenue. This indicates a less diversified product catalog compared to Edenred.
So more exposed to the regulatory risks in benefits.
Potentially, yes. And partly because of this concentration and maybe less scale or tech advantage yet, Pluxee's margins are currently lower than Edenred's. It also has a comparatively higher exposure geographically to Brazil and other emerging markets, which introduces different, potentially more volatile risk profiles than Edenred's more balanced global footprint. Interestingly, and in stark contrast to Edenred's debt profile, Pluxee currently has a net positive cash position. They spun off with cash on the balance sheet. This offers a different kind of financial flexibility, maybe more M&A firepower without taking on debt, or greater resilience if cash flows tighten.
So Pluxee, more focused on benefits, lower margin currently, emerging market tilt, net cash.
That's a good summary. But despite these key differences in diversification, margin, geography, and balance sheet, both companies share significant similarities too.
Like what?
Well, they are both growing at impressive double-digit rates organically. Both are highly active in strategic M&A to fuel expansion and diversification. Both operate in largely underpenetrated markets globally, meaning ample runway for future growth for both of them. And critically for investors right now, both are grappling with very similar regulatory challenges in Italy, France, Brazil, and elsewhere. And both are suffering from the same negative market sentiment that has driven down their valuations significantly.
So the market is treating them somewhat similarly despite the differences.
To a large extent, yes. It makes Edenred, perhaps as the leader with the higher margins and diversification, a particularly fascinating case study in how the market is currently pricing, or perhaps mispricing, political and regulatory risk versus underlying business quality.
Let's talk about that underlying quality. What about competitive moats? What truly gives Edenred its competitive edge? What protects those high margins? It's often said, and you hear management say it, that it's not really easy to enter the segment. Is that true?
I think it largely is true, yes. There are several strong moats protecting incumbents like Edenred. The primary moat, as we've repeatedly emphasized, is the sheer power of network effects.
The three-sided market again?
Exactly. The more users they have, the more indispensable they become to merchants. The more merchants are in their network, the more attractive the platform becomes for corporations seeking comprehensive benefits for their employees. This creates that powerful, virtuous cycle, that flywheel, that is incredibly difficult and expensive for a new entrant to replicate from scratch. You need all three sides simultaneously.
Okay, network effects are number one. What else?
Secondly, there are very real, often underestimated, high switching costs for the corporate clients. We touched on this with mobility, but it applies to benefits too. Integrating a new benefits provider into complex internal HR systems, payroll processes, accounting software, it's a significant operational hurdle. It takes time, resources, and carries risk.
IT projects nobody wants to do unless they have to.
Pretty much. Furthermore, as we discussed, corporate clients often see little value in switching for what they perceive as a standard service, especially when aggressive promotional incentives for switching have been restricted by regulation in key markets like Brazil. Inertia is a powerful force.
So stickiness from integration and inertia, moat number two.
Right. The third major moat, particularly strong for Edenred given their history and investment, is their unparalleled scale and technology. Edenred's global platform, its cutting-edge API-driven architecture that allows easy connections, and its significant multi-year investment in that single cloud-based digital platform. It all provides immense economy of scale.
Being bigger helps.
Massively. It allows them to mutualize development costs, spread operating expenses over a larger revenue base, and deploy new services or enter new markets far more efficiently than smaller or newer players could ever hope to. They can launch new products faster, integrate acquisitions more smoothly, and likely operate at a lower unit cost because they have that robust, modern, global foundation.
Okay, network effects, switching costs, scale and tech seems solid, but
There's always a but.
that begs the question, right? How do these traditional moats hold up against those newer, arguably more agile entrants we talked about, like Swile and Flash in Brazil, who leverage those open-loop payment systems? They can build merchant networks almost instantly using Visa or MasterCard rails. Doesn't that bypass the network effect moat?
That's the key challenge. You're right. The open-loop model definitely lowers the barrier for merchant acceptance significantly. However, the incumbents like Edenred are not standing still, as we noted. They are actively catching up and neutralizing this threat by adopting hybrid approaches. They've successfully done this in France with a SCS network that shared infrastructure enabling interoperability. They're doing similar things in Brazil, integrating with local payment schemes. Their scale actually allows them to develop and integrate these features quickly. And sometimes they can even provide cost advantages through these shared infrastructures. An interesting example was Swile, a key competitor in France, eventually deciding to adopt and use the SCS network themselves, likely for efficiency reasons.
Ah, so the incumbents adapt and maybe even co-opt the new models.
Exactly. The moats are evolving. They're perhaps not as absolute as they once were in a purely closed-loop world. But Edenred is adapting effectively, leveraging its inherent advantages of scale, existing client relationships, and deep regulatory know-how. The competitive edge persists, even if the landscape is changing.
Okay, that makes sense. So given this whole complex picture, the risks, the strengths, the valuation, what could actually make the stock price change? What are the potential catalysts for revaluation that investors might be looking for?
Yeah, what could break the negative sentiment? I think there's several possibilities. One of the biggest, perhaps the most impactful, would undoubtedly be clear resolution of the uncertainty surrounding those French and Brazilian regulations.
Just getting clarity, whatever the outcome.
Clarity helps immensely, and especially if the ultimate impacts prove to be less severe than the market currently fears or has priced in. If that French tax doesn't happen or is watered down, or if Brazil confirms the piety system remains largely intact, that would be a huge positive catalyst.
Okay, regulatory clarity is number one.
Definitely. Linked to that, a lower than expected actual negative impact emerging from the Italian market as the commission cap beds in would also be a significant positive surprise, validating the mitigation strategies. Then, simply continued strong operating performance. If Edenred keeps delivering solid organic growth, margin expansion, strong cash flow, quarter after quarter, reaffirming their underlying strength despite the headwinds, that execution would eventually force the market to reconsider the valuation.
Performance speaks for itself.
It often does, eventually. Broader economic resilience, particularly in key markets like Europe and Brazil, would also help. If fears of a deep recession fade, that removes another layer of worry. And critically, timing-wise, Edenred has a Capital Markets Day scheduled for November 4, 2025. These events are key opportunities for management to provide more clarity on strategy, update financial targets, perhaps offer more granular detail on the regulatory impacts or mitigation plans. Positive news or strong messaging there could certainly serve as a powerful catalyst for a re-rating of the stock.
So, upcoming news flow potential.
Yes. And finally, perhaps more speculatively, but you hear it discussed. Given their stable, cash-generative business models, their essential services, strong market positions, and currently depressed valuations, there's always the intriguing, if maybe outside, possibility that both Edenred and Pluxee could become takeover candidates.
M&A potential.
Potentially.
Huh?
For larger financial institutions, private equity firms, or even big tech players looking for a resilient, high-margin platform business with global reach. The characteristics are attractive, especially at these valuations. That possibility could put a floor to the stock price or attract interest.
Okay, lots to watch for then. Regulatory news, performance, the Capital Markets Day, even M&A whispers.
Right. We've just completed a truly comprehensive deep dive into Edenred. We've meticulously explored its remarkably robust, yet perhaps underappreciated, business model. We've looked at its impressive growth engine stretching far beyond its origins in food vouchers, and we've stared directly into the significant regulatory hurdles it faces across key global markets like Italy, France, and Brazil.
Covered a lot of ground. We really have. It's a fascinating company, isn't it? One that, in many ways, quietly underpins a huge, essential part of global commerce for millions of people every day, yet it finds itself caught right in the middle of a whirlwind of policy changes and, frankly, pretty intense negative market reactions. So, what does this all mean for you, listening in? We've essentially seen this core paradox play out. A high-margin, incredibly cash-generative business, protected by formidable competitive moats, currently trading at a significant discount.
A deep discount compared to its history.
Exactly. And critically, this discount doesn't seem to be primarily due to fundamental operational weakness within Eden itself. The numbers look pretty strong, but rather due to these external, often politically driven pressures that are creating layers and layers of uncertainty. It's a classic investment puzzle, isn't it? Strong fundamentals clashing head-on with perceived external risks.
It really is. And thinking beyond just Edenred's stock price, this whole situation raises a really important, broader question for the future, doesn't it? As governments worldwide increasingly look for ways to influence consumer purchasing power, manage social welfare programs more effectively, and in some cases, directly intervene to control inflation. How will this whole earmarked payments industry, led by companies like Edenred and Pluxee, continue to adapt?
Will there be more regulation? Less?
That's the question. Will we see a further wave of prescriptive regulation like price caps or forced system changes? Or will the industry successfully demonstrate its essential role in facilitating efficient, traceable, and fair benefits, thereby perhaps minimizing the perceived need for further heavy-handed government intervention? It's a real tension. And consider the future of employee benefits themselves. Will they become even more digital, more diversified, more globally interconnected, driven by the innovation of sophisticated platforms like Edenred Plus Blessing, offering everything from lunch to gym memberships to EV charging in one app?
The all-in-one benefits platform.
Potentially. Or, conversely, will local regulations, influenced by evolving political priorities and economic pressures in each country, increasingly fragment the market? Will we see more Italys and Frances, making it harder for these global platforms to operate seamlessly and efficiently across borders?
A more fragmented future.
It's possible. If we connect this to the bigger picture, the story of Edenred isn't just about meal vouchers or fuel cards. It's really a fascinating window into the evolving, sometimes quite contentious relationship between businesses striving for efficiency and profit, employees seeking greater purchasing power and convenience, and governments attempting to shape the digital economy for what they perceive as the public good. So maybe a final thought for you to ponder. What role do you think companies like Edenred will ultimately play, or should play, in ensuring that employee benefits are both efficient for employers and genuinely fair and valuable for employees in this complex, interconnected, and increasingly regulated future? Where does the balance lie?